Good afternoon, all of you. As we all know, the insurance industry is a deep pocket industry. Having said that, it is one of the most difficult industries to generate sustainable profit growth. Hence, being a CFO of an insurance business is no easy task. The CFOs have to constantly juggle between managing capital and getting their ALM right. And again, with an increased focus on technology and digitization over the last few years, and with the emergence of insurance tech, there is always this clamor for allocating capital towards them. Now, against this backdrop, I would like to invite some prominent industry CFOs to understand what are their concerns and gain valuable insights and inputs in managing the same. I would now like to introduce the members in a panel today. The first one with us is Mr. Mathivanan Balakrishnan, the CFO of IDBI Federal Life Insurance Company. Mr. Mathivanan comes with more than 23 years of progressive experience in finance and operations management, both with startups as well as established organizations in the life insurance sector. Prior to joining IDBI Federal in 2007, he had successful stints in corporate finance and operations with AMP Sanmar Life and Reliance Life. The next one on our panel is Mr. Cedric Fernandes, the CFO of Kotak Life Insurance Company. Mr. Fernandes has over 2 decades of work experience, most of which has been with the Kotak Mahindra Group. He joined Kotak Mahindra Old Mutual Life Insurance in 2001. In his immediate prior assignment, he was the finance and accounts functions in the company. He played a vital role in establishing processes and systems and contributing to global best practices. The next one on our panel is Mr. Miranjit Mukherjee, the CFO of Future Generali Life Insurance Company. Miranjit has been the CFO of Future Generali for close to 5 years. In his previous role, he was associated with Tata AI Insurance Company Limited. And last but not on the panel, Mr. Gopal, the CFO of ICICI Lombard General Life Insurance Company. Mr. Gopal, a chartered accountant with more than 20 years of experience, been associated with ICICI Lombard for close to decades. Prior to ICICI Lombard, 2 years ICICI Corporate Account Taxation Department, and he has the distinction of making ICICI Lombard the first Indian non-life insurance company to be listed. So welcome all gentlemen. As we know, the overall focus for the insurance industry is to get the operating model going, thereby throwing varied challenges and opportunities. Now, in this context, while the overall blueprint to achieve the same is laid down by the CEO or the strategy council for a company, the role of CFO is quite critical to implement, monitor those priorities, and thereby help the organization to get to that optimum operating model. Now, to reach that optimum operating model, I'm sure there are some challenges to achieve the same. So let me start by asking Gopal, this question. As we can see that InsurTech had already started coming up as a disruptor with distribution channels, and we are seeing a shift from the traditional physical channels to digital channels. With this pandemic, the traditional channel has been further challenged, isn't it? So what do you see the impact of the same on the insurance
So good
industry in
afternoon.
general
Thanks,
going forward?
Arvind, and
Gopal,
good
your
afternoon,
thoughts on the
everyone.
same.
So if you look at the operating model of the non-life insurance sector, ours is a sector which has got a mixed bag. We get to experience certain products which fundamentally gets sold largely in a physical format, and equally there are certain product lines which can kind of take through the path of the digital way of selling. But the way we would look at is in terms of the approach that one would want to take on the operating model, it kind of fundamentally changes gears, particularly in the COVID-19 situation, as all of us has experienced. That obviously physical reach was not definitely possible, and hence one had to significantly calibrate on what would be the way of still continuing to run the businesses in the way how you would want to have seen it operating. Now, in that context, I think companies which have been kind of successful in doing two, three things in managing this entire transition is one, put in place a de-risk model, which is to say that you don't have all of your eggs in one basket. And so that in the event, if anything was to get materialized, then to that extent, the entire operating model gets put to test. and hence survival of the institution becomes difficult. So hence, to that extent, I think one of the foremost learnings that one would want in this scenario is significantly look at a de-risk model, and to that extent, something or the other clicks in at times of adversity. So that's one. The second is, I think there is a need for you to be continuing to maintain prudence, because there are two paths that organizations can take, particularly since we are talking of in the insurance context. We all know for the fact that the levels of under-penetration of the market is quite significant, and the opportunity for growth is equally humongous. Now, there are paths that one could take in terms of significantly only riding the revenue objective, and in the process, possibly losing sight from a bottom line perspective. And in these testing times, I think it again becomes extremely important from an operating model standpoint to again have a fine balance between continuing to stay focused on driving the revenue opportunity that one sees, but equally trying to stay focused insofar as the contribution to bottom line objective is concerned as well. And in that regard, when you look at it from an ICICI Lombard perspective, I think not just in these current times, but even over the years, the operating model that we have largely advocated is to significantly focus on profitable growth as a theme in order to run the businesses. And equally, I think the fact that I spoke about when Arvind, you spoke about InsurTech and digitization, I think again as a company we have been early adopters of digital, and when we look at digital, it's not just about with respect to sourcing of policies. We look at digital across the three spectrums of sourcing, claims management, and even when you look at internal processes. So that's how we have looked at the overall environment in the current times in terms of how you can look at shaping up an operating model. That's the initial comments that I would leave with.
Thanks, Gopal. Thanks for those inputs. Really just gives a broad canvas in terms of you just don't look at digitization or a distribution channel only from a sales side, but from an overall transformation to the company as a whole. So yes, that absolutely makes sense for an overall operating model to work for an insurance industry. Now, taking cue from that, uh, Cedric, I would like to ask you this question. I mean, need of the hour in investment in right technology, has helped companies a lot during this pandemic. Now, considering that the insurance industry was one of the essential industries which had to keep working during the pandemic, so how do you visualize the increased use of technology and its likely impact on insurance companies as a whole? What are your thoughts on that, Cedric?
Arvind, thanks for the question. I think so. It's a very good question in the current times. I think so. Insurance companies, general both life, I think so, recognize the need of technology and digitization, data analytics, because that gives you good impetus across distribution channels, your operational processes, risk processes. But in this time of COVID, it has actually accelerated the entire process. Okay, and this year has been a challenge for us. But I think so in this year, none of the insurance companies would have cut their expenditure on digitization or going digital. Because if you look at a part of the overall strategy of the business, channels or the operations process, risk processes as a investment for the future. I would see that all insurance companies would significantly invest in this year. This year may be slightly prudently because it is the initial year, but going forward, the next 5 years, I think so the spend on investments in the digital channels and IT is going to considerably increase. And the reason for that is also, if you look during this COVID time, the customers are actually the ones who are asking for it. Customers have gone online, they have felt the need of insurance, they want to buy it like any other product, and the regulator has recognized it. If you look at it, the recent circulars from the IRDA, where they have come about with a lot of relaxation in terms of getting wet signatures and allowing things to be done online. I think so these two signals which you get from a customer and a regulator, in addition to your own push, has actually, made it, I think so. It is not an option now for insurance companies. It's a matter of how fast do you want to go. So I think so. In these times, while we have to be prudent on other costs, IT and digital is being a significant part of, you can say, the strategy. There will be a substantial investment going now and forward in this entire in the space of insurance. That is how I see it going ahead, because digital, while the initial cost may be high, it is one of the avenues which allows you to reduce your overall cost of distribution or production or control. And ultimately, insurance companies are looking at the overall reducing the cost so that they can give a better product to the customer in the long run. So I think so that journey has begun. It has only got accelerated during the current year.
Okay.
Yeah, Arvind,
Thanks.
now that is what I have to say.
No, Cedric, absolutely insightful. And again, building up on that whole point in terms of how the industry is going to pan out or change in a big way, the necessary investment required in digitization and technology, I'm sure there is going to be a challenge in terms of how do we manage that. And coming to this, taking a cue from this, Miranjit, I would like to ask you a question. Is to say that with availability of technology, do you see a change in the consumer preference, or do you see a change in the product mix, which you need to cater to in the future? What are your thoughts on that?
Arvind, thanks. So, Arvind, let me segregate this question into two parts. Arvind,
Yes, sir.
Cedric has re-emphasized the point, and as Gopal has re-emphasized the point, we had to accelerate the investments into IT, because without it, you wouldn't have survived the pandemic. And most insurance companies have invested very heavily during this phase. I, however, have still one view, Arvind, especially from the day the customer still wants a face-to-face meeting. And as much as we want to wish away this issue, remember that the customer is investing for, I'm not talking of non-life being a 1 year or a 2 year product can still have, online complete. But for a life insurance company, the customer is investing for almost a 10 to 15 year horizon. And our personal experiences have been that as much as we want to be as digital as always, and especially with us, we don't have a bank partner. And so what happens is that our proprietary distribution is our prime source of revenue. So customers have said, very well, we are more than willing to tie up or do business with you. But at the end of the day, you please come and meet us and in person still, do the fulfillment of the deal. So the point is that digital has got accelerated without a shadow of doubt because of the pandemic. But I can't wish away the fact that a face-to-face meeting, especially for life insurance business, would continue to play a very significant part. That's the first part of my answer. The second part of the answer is, Arvind, what's happening is that, thankfully, we are, most of the financial services business are very regulated. And so, and especially with insurance companies, because they don't have to take too much of leverage other than some of the larger ones, customers have a lot of, especially for life insurance companies, have a lot of faith in the system in India on life insurance, because after bank deposit, that's the most preferred product. And what we're increasingly noticing is that customers, obviously because of the pandemic, has shifted very significantly to term, health, etc. But we still see a major uptake in the guaranteed savings products in a very, very significant way. That continues to be a very big source of revenue as we go along. Bank promoted companies still have ULIP in a very big way. But what we're noticing is that the customers still prefer a lot of savings, now coupled with the fact that they want a lot of protection business. Yeah, that's my take.
Okay, thanks, Miranjit. So, to achieve all of this, I'm sure whether the right technology or to cater to those consumer preferences, getting the right skill set is always a challenge. So, Mr. Mathivanan, I would just like to ask you, with the likes of artificial intelligence, large amounts of data, how has the need for physical workforce evolved? And how do you see the availability of relevant skilled staff for the insurance industry in the future? What are your thoughts on that, sir?
Yeah. Thanks, Arvind. Before answering this question on the operating model related, actually, as a CFO, we are all challenged what should be the right operating model in the current pandemic crisis is a critical answer. So we are all facing the challenges like what should be the right operating model in the current scenario. How do we go about on the business growth, the availability of the data to make the different scenario based planning and budgetary planning for multiple rounds of discussions. That is becoming a really challenging in the current scenario. So coming to your question on the artificial intelligence and the digital transformation, as Cedric mentioned before, the digital journey has already been there in the insurance companies for a couple of years. It has been accelerated now in the current pandemic crisis. So to meet even the regulator has taken several steps to ease the compliance and the regulatory requirements. From that perspective, yes, it is a challenge for us to meet the compliance and the statutory requirements from the current environment. And with respect to the regulatory related, one of the important regulatory change which is actually good for this current scenario is the regulatory sandbox regulations, which talks about to promote the development via experimentation, facilitate innovation and encourage a digital journey is an important regulation which all insurance companies should make use of these regulations to innovate and to bring in more automation into the process, whether it is an operational processes or a business process or financial processes, to bring in such kind of digital is important. That's the need of the heart today. And and the question, specific question on availability of the skilled resources for managing this. Yes, this has been a challenge for us because people, the most of the resources are work from in a remote place, not meeting each other for so many months and days. Getting the meeting these regulatory requirements in timelines with a lot of accuracy has been a challenge for the CFOs in the current scenario. Yes, we need to have people trained and on the new set of skill. They should be used to how to work from home effectively for the organization.
Sure. But thanks, absolutely, Mr. Mathivanan, for your thoughts. And Miranjit, maybe asking this question to you specifically because you touched upon that point in terms of changing environment and the risk being prevalent. All of us, I mean, it's a no-brainer that yes, the pandemic has plunged India into recession. We have seen, a good enough Q2 GDP numbers. They show a good recovery. But is it a sign of recovery? And can we say that the worst is behind us? Or whether the cards? I mean, nobody knows. I mean, the future is out there for all of us. But in such an environment, any thoughts on this, Miranjit?
Yeah. So let me make it an industry-specific issue and a company-specific issue. So I must say the regulator has been quite proactive. So first, let me not only talk of the insurance regulator. I think SEBI, because some of our other companies are listed, some of the insurance companies are listed. So SEBI is trying their best to support in this environment. I think the insurance regulator has also tried to support us in this environment. And what they're trying to do is accelerate the approval process that we generally put up to, whether for product, for any process that we are changing. And most important is that we've seen a very significant change in which they're trying to reach out to companies, really to ask them whether they need any specific help. In our particular case, we needed an approval for an infusion for debt. And I must thank the regulator for being very, very proactive in supporting. Because, in these times, especially all of us working from home and almost having no physical interaction with one another and not getting a chance to meet the regulator, I think the regulators have been very, very supportive. And I say not only the insurance regulator, if you relate to it, the banking regulator, who's almost the Reserve Bank governor almost comes on a television every 2-3 months and lists various schemes that they're offering. The SEBI has done a lot of things to support, and the insurance regulator, obviously, that we relate to them. They've been very, very supportive. I think the best bit is that they've been reaching out to companies and to the industry, asking that whether you need any support from our side. And I think all kudos to them.
Sure. Great. On another note, consolidation has been the mantra for the insurance industry in general. And over there, asset liability management or capital management, they just become priority tasks for any CFO of an insurance company. So, what do you think? Maybe Gopal, you might give that answer first because you've gone through an acquisition yourself. What do you think the mantra is? Is consolidation the theme going forward? And what are your thoughts on that in general?
That's a good question, Arvind, because you always find opportunities and adversities, right? As what it's always said.
Yeah.
And that's how you kind of look at possible scenarios emerging. So let me just again put it in the context of the industry. I think one of the things that I mentioned originally was the path that institutions take, right? Particularly, we are in the business of, let's say, particularly on the non-life side, we are primarily in the business of, let's say, taking premiums from customers, and we obviously have an obligation to make good those payment of premiums in the form of claims, as and when they were to materialize. The beauty of the business is, while Miranjit said that the term period of our policies are maybe relatively shorter duration as compared to, let's say, the life side. But insofar as claims development is concerned, there are certain businesses which kind of fundamentally runs over relatively longer periods of time. And hence, given the uncertainty that comes, particularly with respect to this long-term development of claims, each companies needs to be extremely prudent in the way they run their operations or in the way they build their operating model. And there have been, let's say, challenges in the market with certain participants possibly trying to be far more aggressive insofar as revenue objectives are concerned. And possibly, I'm sure they would have had their own objective in so far as meeting their bottom line targets are concerned. But in these times, when I said, particularly during these stressful scenarios, even the preferences of the customer starts to significantly shift to players which are relatively carrying a stronger brand, which have got a better balance sheet, and at the same time who are equally kind of reasonably comfortable insofar as solvency or capital adequacy positions are concerned. And in this backdrop is when, and these are also times when, let's say, the ability of the promoters or the investors who are backing the companies, they may also not necessarily have deep pockets of being able to continue to make investments over a relatively longer period of time. And it is in that context is where possibly you get to see opportunities emerging. And that's how, I mean, when you rightly mentioned that we did make an announcement of an acquisition as we speak, it is how that's how we are kind of looked at this opportunity. This was something that ICICI Lombard had kind of reached out to Bharti AXA in terms of the opportunity that we looked at. And clearly, I think there are various filters that we would obviously look at before looking at any transaction. And the beauty of the transaction that we currently announced, I think kind of checkboxed most of the things that we would look for in a transaction, which is strong governance, good management, in terms of their disclosures, reserving practices. I think they were all kind of fitting in the right checkboxes. I think it's just that the opportunity of the business would have kind of played through over a relatively longer period of time. And that's exactly where I think from an ICICI Lombard perspective, on a merged basis, we would be able to realize some of those synergies from a long-term standpoint. But yes, your point is absolutely right. Where there are, in these times, you get to see companies, unfortunately, maybe who may not be necessarily having the desired capital for which they will be able to continue to maintain infusion momentum, or for the matter of fact, the players who would not have been, let's say, relatively prudent insofar as, let's say, the underwriting practices are concerned. you get to see definitely opportunities of consolidation. And what we have seen is maybe few examples of consolidation in the non-life insurance space. But my sense is over the next maybe 3 to 5 years time horizon, we would definitely get to see far more opportunities emerging. And there are and players who are, as I said, relatively having a strong brand, very good balance sheet, and a relatively better solvency position. I'm sure they would all be kind of looking for opportunities as and when they arise. That's how we have looked at the consolidation space.
Sure. Maybe tempting as an accountant all my life to ask this question to maybe Cedric. There is IFRS 17 which is coming up on the horizon. As they say, it's a game-changing standard. There is also RBC which is there on the minds of the regulator. How soon, Cedric, you think, or what impacts do you think will these initiatives matter to the insurance industry as a whole, and how do you see the regulators playing their role in this?
Yeah,
Cedric,
I think
thoughts?
so. Another good question, Arvind. I think so. IFRS, my own view, IFRS 117 is going to change the way in which people look at insurance companies, because of two, three reasons. One of it is that historically we are always showing you the balance sheet and the P&L of what has come through the P&L, and therefore it's only the net worth. But IFRS goes to try and capture the entire embedded value onto your financial accounts, and also does a lot of sensitivity and disclosure so that you can read and understand the numbers, which is not there currently. Two, it is casting the onus on the CFO, because IFRS 117 is finally an accounting standard. And although there is a lot of actuarial input on the side, but finally certification of those numbers and an audit today, which we rely on only a certificate in the actuary, is going to move to a CFO role and an audit role. So I think so these two in combination puts the onus on the CFOs to basically understand the numbers, get data, and also validate everything what is coming through the embedded value on the financials. I think so. Today, any insurance company, the key to look at is the embedded value. Today, it is done by refer to the financials only. So, I think so. It is bound to happen. It's only a question of timing. Internationally, the date is maybe 2023. Because of the pandemic, maybe there would be maybe a slight delay here and there. But private insurance companies like us, somewhere through the holding company or through pressure, whenever we are listed, will make us actually get into an IFRS 17 kind of transformation sooner than we expect. So I don't think so. While the government may make it mandatory, I do not know the date. Today it is going maybe in line with the international deadline. But I would think so. We will be compelled as insurance companies to do it for the purposes of our own valuation. Because the moment it gets adopted in Europe, and for any listing purpose, any kind of capital which we need, I think so there's no option. We'll have to do our financials through 117, and we'll have to do, we will get our valuation, we'll get our embedded value and basically a valuation only based on those numbers. So I think it's a big step for the CFO's office. It puts a lot of onus, because understanding of the entire actual principles involved is good. But I think so our time has come when where we have reached that stage. It gives us a great opportunity, because as finance professionals, we are getting now into a complete insight into the actual way of how do we estimate the future. And there will be a lot of onus on the CFO's office to ensure that all numbers are understood well and explainable. And I think so this in the future will play a very key role in understanding the future of any insurance company. So I think so it's a welcome step, and I don't think so it will take a lot of time. It is not in the distant future. While there may be some deadlines which the government may extend, but I think so as individual entities as we are, we'll be compelled to do it sooner than later, I think so. That is my view.
Great, Cedric. I think that sets the tone. And thank you all. We have that limited time in terms of trying to close our session. But I would just like to probably take this opportunity to say that thank you for your time, gentlemen. Now this discussion has been extremely enlightening. Now hosting an insurance summit electronically indicates in more than one ways, right? The shift in the way we see the things evolving, right? That itself tells us lots of things to all of us. So the insurance industry has also seen the rise of technology usage. InsurTech is becoming a regular part of our dictionary, as we say. And last but not the least, IFRS 17 or whichever is the new regulation which is going to probably change the way financials will look like, looks to be a reality, if not immediately, but in the near future. And it's something which we can't wish away with. So, the few key takeaways from the change in the ways of we doing the business from my side would be, if I were to summarize, is technology would play a large role in insurance, both in operations and distribution. Along with conventional skill sets, employability of individuals would depend on agility of the workforce to upskill themselves with technology developments. And faced with challenging tasks as a CFO, whether it is IFRS implementation or whether it is implementing technology, allocating cost, it is a no-brainer that the insurance business is and will remain a vital contributor to the cog, the wheels to the economy in times to come. And this can only happen with the constant support and guidance from the regulator in managing this changing dynamics for the industry as a whole. So that's what I could gather from you. And thank you sincerely for your valuable inputs and thoughts. It really just helps or opens your minds to gaze into the future and see how one can navigate through those risks in the changing dynamic. Thanks a lot. Thanks, Martin.
Thank you so much, and request everyone to stay safe at this time. Thank you.
Thanks, Arvind. Thanks.
Thanks, Arvind.
Thank
for
you.
giving this
Thank
opportunity.
you.